So for the students who are just joining us right now, we have a very good example. I promised to do one question, actually two of them, on portfolio management. As we close this so that we can go to the mergers and acquisitions question that I promised to you. Yeah, great. So what some good student is telling me here, ladies and gentlemen, is that the first thing that I need to do for this kind of a question, where they have given us 3 projects, ladies and gentlemen, we have expected returns, we have the risk-free measured there for the projects there, and then we have the coefficient of correlation. Expected return from its capital projects is 15%. 15%. Remember, whenever the examiner talks of capital projects, you are supposed to know that capital projects are market portfolios. What have I said? Anytime they talk of capital projects, at times they use the word capital or existing projects. Projects that are existing are the projects whose products are selling in the market. So in this case here, capital projects, ladies and gentlemen, these are the same as what here? These are the same as market portfolios. So in short, this 15%, very few students will be able to pick it as a ERM. So this is supposed to be expected return of what here? The market. So ladies and gentlemen, I'm emphasizing again that expected return from its capital projects. Capital projects are the same as existing projects. These are the same as what here? Market portfolios or market projects. So in short, the expected return that is being given here is expected return from the market, And then they're telling us the standard deviation of capital projects, ladies and gentlemen, the standard deviation of capital projects, they are giving us the standard deviation of the market like that. They're giving us the standard deviation of the market like that. Risk-free rate of return has been given to us. This is our RF, ladies and gentlemen. And then they're asking us here to use CAPM and advise this company on the projects here to be done what year to be accepted. Ladies and gentlemen, there are students here who are really making me to be happy. And I even feel that this question could be very easy for all of us. Perhaps we need to skip it. What is the general feeling of the students in this class? Do we do this question or we skip it? Because there's some 2 students who have given me heads up, in a way that tells me that perhaps all the students will be knowing how to do this question, Lee says no, Rose says do it. Okay. Perhaps it's only 4 students who don't know how to do it. Perhaps I could give them a video for this. If it's only 4, is it 4 or there are many other students who are really saying, let's do it. I'm counting. Tufanye, I'm counting. Tufanye nayo, tuchangamke nayo. Sasa nisikize vizuri. Ikiwa wamesema CAPM, wewe unafaa ucheze kama wewe. Ukisikia CAPM, you know straight away that CAPM, the very first thing you need, CAPM straight away is a systematic risk thing. Systematic risk. And systematic risk is normally measured using beta. Systematic risk is normally measured using beta. In many questions, you will get a situation where the examiner gives you beta directly. But now here, this examiner has not given us beta. So if he doesn't give us beta, if the examiner doesn't give us beta, then ladies and gentlemen, we must calculate this beta ourselves. And of course, for us to calculate this beta ourselves, beta of security J, we know that there are 2 formulas of calculating this beta of security J. Who is able to remember those formulas of calculating BJ? Can somebody remind us? BJ equals what? Yeah, there are 2 formulas. There is the covariance approach and there is the correlation approach. There is the covariance approach and then there is the correlation approach. So somebody using the covariance approach, is there somebody who is able? Yes. Beth has reminded me. Yes. Thank you very much. Although Bernard, there is something you're losing out there. Remember, it is supposed to be beta J. It's supposed to be covariance between J and M because you're relating this particular product with the market. So covariance between J and M divided by the standard deviation of the market done what here? Squared. Divided by the standard deviation of the market squared. Yes, what 𝐁𝐿𝐈 is calling the variance of the market. Remember, when you square a standard deviation, you are basically getting what here? The variance of that product, the variance of the market. This is the same as variance of the market. Thank you very much. So this is formula number one of getting beta J. But now, ladies and gentlemen, when I look at around, I realize that this is a serious examiner. This examiner has not given me covariances. The examiner has not given me covariances. What he has done, he has given me correlations, coefficient of correlations. So when he gives me coefficient of correlation, I don't have covariance, meaning that I can't apply formula number one. What do you think should I do in an exam? Cry? Cry? What should I do in an exam? What should I do in an exam? What should I do in an exam? When I'm given correlation coefficient, ladies and gentlemen, what should I do in an exam? Correlation. The second approach, remember I told you that there are two approaches. We have the covariance approach, and then we have the correlation approach. You can see, ladies and gentlemen, what Olivia is telling us. That if it is the correlations approach, we normally take the correlation between the security and the market. So correlation between J and M multiplied by the standard deviation of the security J all over the standard deviation of what here? The market. So if I were you, I would have written that this is the covariance approach. This one is the covariance approach, and this is the correlation approach. And that is the correlation what here? Approach. That is the correlation approach. Thank you. Thank you. Thank you very much. Ladies and gentlemen, because this examiner has used the word 𝐿𝐴𝑚, when he uses 𝐿𝐴𝑚, then straight away we need to look for beta factors if they are not there. We need to look for beta factors if they are not there. So could you then kindly do me a favor? Kindly do me a favor here. Kindly do me a favor here. Come and give me the beta factors of the three projects. Give me the beta factors of the three projects. Please give me the beta factors of the three projects. So beta factor of A. Beta factor of A. So what we are doing, we are taking the correlation coefficient of A. The correlation coefficient of A from the question that I've just rubbed, the correlation coefficient is 0.58. So 0.58, thank you very much, 0.58 times the standard deviation of the project. Do we have the standard deviation of the project? Do we have the standard deviation of project A? Do we have standard deviation of project A? So remember, I'm taking the correlations were given down here. Actually, if you guys are good, you can even take a screenshot of that question that you have just written, and then you throw it on our WhatsApp group. Just throw it inside there. Throw it inside there. So we have 0.58 times the risk. Risk is the standard deviation. And the standard deviation given, ladies and gentlemen, here for A is 1. You can omit the percentage. Omit the percentage. All over the standard deviation of the market. Is there somebody who is able to remember the standard deviation of the market? Is there somebody who is able to remember the standard deviation of the market? It's given somewhere, 2.5. Always be omitting the percentages because they'll tend to cancel out. They'll tend to cancel out, always. They'll tend to cancel out. So could you kindly then give me this beta of A? Give me this beta of A. So 𝐿𝐴𝐅𝐅 gives me 0.232. Thank you very much. Thank you very much. How about beta of B? How about beta of B? Beta of B. The same. I'm looking for the correlation coefficient of boy. The correlation coefficient of boy, I can see there from what I deleted, is 0.89. 0.89. So we have here for boy is 0.89 times, ladies and gentlemen, the standard deviation of boy, which is 1.2, divided this by the standard deviation of the market, which will remain constant at 2.5. So could you kindly give me this answer? Please help Eric there. Help Eric there. Take a screenshot of that question. Caro, Olivia, all these good students, Elim, all of you are good. Please take a screenshot of that question. Take a screenshot of that question and throw it where? Throw it straight away. Throw this to our WhatsApp. Beth is asking, where do we get this 1 over 2.5? It's very easy. I'm using this formula. You take that correlation coefficient, 0.58, times the standard deviation of the security. Standard deviation is here. Standard deviation of A is 1, all over the standard deviation of the market, which has been given. All over the standard deviation of the market, which has been given. For the sake of the students who have just joined us, can we take like a minute to breathe for these students here to catch up with us? So please remember that we have, I think, 2 WhatsApp groups. It's important for members who are here in the, coming from different respective WhatsApp groups. Please screenshot the question and send it to our respective WhatsApp groups, tafadhali. And then I'm giving you exactly 1 minute, exactly one minute. Try to understand the question. Try to understand the question, go through it. Try to understand the question, go through it. And the most important thing as you try to appraise yourself of that question is to know that expected returns of capital projects, our capital projects are what here? These are our market portfolio. So expected return of our capital projects is the same as what here? ERM. It's the same as ERM. It's the same as ERM. It's the same as ERM. Is the same as ERM. Okay. So I think 1 minute is over. It was 1738. Right now it's 1739. So Pamela tells us that beta of B is supposed to be 0.427. And I can see so many students confirming that indeed that is it. How about beta of C? Beta of C. So beta of C, what do we have here? Are you able to see the correlation coefficient? Thank you very much. The correlation coefficient of C, the correlation coefficient of C is a negative 1. The correlation coefficient of C is a negative 1. It's minus 0.1. It's minus 0.1. So once I have these times, ladies and gentlemen, times the standard deviation of C. The standard deviation of C is given here. It is 2.4. Divide this by the market standard deviation, which is 2.5, and I'm being given an answer there of negative 0.096. Now, ladies and gentlemen, listen to me and listen to me very well. What you have done here is not giving us a solution to the entire question, no. It is an appreciation that for us to be able to use CAPM, ladies and gentlemen, we need beta factors. And once you have now the beta factors, moving forward will not be a hard thing. Moving forward will be a simple thing. What do I need to do, ladies and gentlemen, for me to be able to move forward? Remember, the examiner wanted me to appraise these particular securities using CAPM. So using CAPM, is there anybody who is able to remember the CAPM returns formula? CAPM returns formula. Is there anybody who is able to remember the CAPM returns formula? CAPM returns formula. CAPM returns formula. So CAPM returns formula, we know that CAPM returns equals who? CAPM returns of a security will be equal to somebody. How comes nobody has written for us? Thank you very much. I can see several of them. Juliet has told us that this has to be risk-free plus into brackets ERM minus risk-free multiplied by beta of a security, yes. Multiplied by beta of a security. So please do me a favor, come and give me the CAPM returns of A, CAPM returns of B, CAPM returns of C. The 3 of them. CAPM returns of A, CAPM returns of B, CAPM returns of C. Please help me. Please help me. Please help me out. So CAPM returns, have they given me the risk-free rate of return? Have they given me the risk-free rate of return? They are not reading that question that has been posted to them on WhatsApp. They are not reading. They are not reading. So somebody tells me it is 6. Ladies and gentlemen, for expected returns of the market, I'm repeating this for the umpteenth time. Expected returns of the market will always be exactly equal to the returns of capital projects or the returns of what year? Existing projects. So whenever they talk of existing projects or, ladies and gentlemen, capital projects, please remember that that is your market. You've invested your capital into projects whose products are selling in the market, whose products are selling in the market, whose products are selling in the market. I hope that is correct. I hope that is what you have taken down. So do we have these expected returns of the market? Yes, 15. So 15 minus risk-free is still 6. Fortunately, you had given me the beta. You had given me the beta of my security. You had given me the beta of A. So beta of A, beta of A, beta of A, beta of A, beta of A. Somebody told me some time back that beta of A was 0.232. Beta of A is 0.232. So please, following your body mass very well, could you kindly give me this answer? And I can see a student who is complaining that they haven't gotten that question on WhatsApp. I can see a student who is complaining that they haven't gotten that question on WhatsApp. And I told you, we have many types of groups of WhatsApps here. That is the essence of online classes. Phoebe anasema, though nasomea kwa mat. Thank you. Thank you. Thank you. So unasema, it is 8.088%, and I like the way they are now consistent with what here? Decimal places. There are 3 decimal places. So please go to B. B, what do we have? Every other thing will remain the same. Every other thing will remain the same except for the risk profile, risk factor, and the risk factor is what they gave me as 0 point something. The risk factor is what they gave me as 0 point something. The risk factor is what they gave me as 0.427. 0.427. So please ensure that you are following your body mass very well. So you say 6 plus open brackets, 15. I'm following this formula, minus 6, you close, times 0.427. Please give me an answer. Please give me an answer. Please give me an answer. When there, she's telling me that this is 9.845 approximately. Thank you very much. Of course, that is in form of percentage like that. So for C, we'll come and talk of the same 6 risk-free cuts across. Risk-free cuts across. The same case with the expected returns of the market. Wanga anaona wanafunzi wengi, ukimwambia expected return of the market ya C, anakimbia wapi? E. Anasema 6%, which will be disastrous. Expected returns of the market wanga inabaki constant throughout. It's a benchmark portfolio whose returns will be used consistently to evaluate performance of all the others. Look at this. We are not saying expected return of C. No, we are saying expected return of the market, which we took as what here? As 15 minus 6 multiplied by negative 0.232. No. The last one, beta for C wasn't like that. Beta for C wasn't like that. Sorry, that one I'm wrong. Beta for C wasn't like that. That one I have to confirm. Beta for C wasn't like that. Beta for C was negative 0.096. Negative 0.096 like that. Please, here again, I have a problem with some of my students because they don't follow body mass. They keep on saying equals in between. No. You take your calculator, say 6 plus, open brackets, 15 minus 6 close. Don't say equals, say times this. And then you say equals. What figure are we getting? Somebody there. What figure are we getting? Somebody there. What figure are we getting? Somebody there. So in this case, I'm being told it's 5.136. It's 5.136%. Now, between the 3, A, B, C, on the basis of the figures that you have here, which project do you think should we invest in? Because that is the question. Which project should we invest in? Which project should we invest in? Which project should we invest in? Ladies and gentlemen, that is the worst decision you can ever make in your life. The worst decision you can ever make in your life is to decide on the basis of CAPM returns. Please, we do not decide on the basis of CAPM returns. Anytime you have CAPM returns and the examiner wants you to make a decision, we normally decide using profitability index. We normally decide using profitability index. And if you remember, so you're saying that profitability index is the key to our decision making. Profitability index, thank you very much. Profitability index is what we use to decide between projects and say, really, this project is a loss-making one. This project is a good one. So the profitability index, we are supposed to come and calculate the Jensen's alpha value. The Jensen's alpha value. So Jensen's alpha value, we can recall, alpha value of any security, ladies and gentlemen, of any security, will always take the expected return of a security minus the CAPM returns of that security. Minus the CAPM returns of that security. So you take expected return minus the CAPM returns of that security. Great. So like, for example, if it is A, we know the expected returns of A. These are 10% minus the CAPM returns of A, which happens to be 8.088%. Could you kindly give me that figure? Kindly give me that figure. Kindly give me that figure. So Lokai tells me it is 1.912. Thank you very much. And somebody has been able to remember very fast that this thing is profitable, even if it's profitable by just 1 shilling. So long as it's positive. We say what here? It is super efficient. It is super efficient. It is super efficient. Super efficient. Now, ladies and gentlemen, let me ask you a question. At times, the examiner will tell you to categorize these securities in terms of them either being overvalued or undervalued. These super efficient securities, are they overvalued or undervalued? So it is super efficient stroke what here, somebody? Super efficient stroke undervalued, yes. Stroke undervalued. Stroke undervalued. Super efficient stroke undervalued. Super efficient stroke undervalued. Stroke undervalued. When somebody, for example, if you're to mess with me today here, and then I tell you that, you know what, you are just overvaluing yourself for nothing. Anybody who overvalues himself, automatically that is a loss-making person. That is a useless person. Good securities, ladies and gentlemen, good securities are those securities with a high potential. These are securities which are what here undervalued. Whenever you deal with securities or properties that are undervalued, automatically you make what here? You make a profit. You make a profit. So please remember, it is super efficient or what here? Undervalued. How about boy? How about boy? How about boy? How about boy? So for boy, the alpha for boy, ladies and gentlemen, I'll take the expected return of boy, which is 8. So I'll talk of 8% minus its CAPM returns for boy. CAPM returns happens to be 9.845%. So then this one here will end up giving us what figure at the end of the day? I'm being told it's negative 1.843. It's a loss-making thing. So straight away, I'll tell my examiner that this is what here, somebody. It is an inefficient. This is an inefficient security and I can't recommend it. I won't recommend it. I won't recommend it at all. I won't recommend it at all. I won't recommend this at all. Ladies and gentlemen, from there we go to the next one. We go to the next one, which is what here. Of course, if it's inefficient, thank you very much for that reminder. If it's inefficient, it means that it is a security which is overvalued. It's a security that is overvalued. And then now we go to the last one. How about alpha of C? So alpha of C, following this formula, I'll take the expected return of C. Expected return of C is 6% minus the CAPM returns of C. CAPM returns of C is 5.136. 5.136% So then this one here will end up giving us what figure? Super efficient of 0.864. Thank you very much. Thank you very much. Now, ladies and gentlemen, as I wind out of this particular, as I get out of this particular CAPM concept here forever, I'll never mention it again. Can somebody give me any 3 key assumptions of CAPM? 3 key assumptions of CAPM, the ones you can't forget, the ones I gave you last time without looking at your notes, which are those particular ones that you will never forget at all. At all. Peter, you're taking so long to reason. You're taking too long to reason. Assumes investors are risk averse. I like that. It assumes, ladies and gentlemen, that we have a market portfolio. We have a market portfolio whose returns are known in advance and will remain constant. I like that. And of course, Carol's assumption of indifference curves is, of course, tied together with market portfolio. Market portfolio, single factor model. I like that. That we have, ladies and gentlemen, a risk-free asset whose rate of return is known, which will remain what here? Constant. Which will remain constant. Perfect markets, of course, perfect markets cuts across very many models in AFM. Perfect markets are those markets where there are no transaction costs, no taxes, etc. Single period model, I like that. Thank you very much. Thank you very much. Now, I'm tempted to leave this particular CAPM thing, but ladies and gentlemen, there is still something, one more question that I think if I do this, now we shall be sorted. We shall be sorted. When I do this, now we should be sorted. We should be sorted. Ladies and gentlemen, here we are. They have given us projects. It's a good situation where they give us projects. We have A, B, C, D, A, B, C, D, E. So they have given us initial outlay, wametuambia hapa ni 1,000, and then we have expected cash flows. Expected cash flows, 1095, and then of course they have given us beta there, which is 0.3, beta there, which is 0.3. So that is A. Ladies and gentlemen, after that, we go to B. B, again, they have given me 1,000 here. 1,000, 1130, 1130, 1130, 1130, and then we have 0.5, 0.5. And then we have C, ladies and gentlemen, where they give us 1,500, 1,500, 1780. Quite an interesting question. 1. Ladies and gentlemen, after that, D, we have 2,000. 2,000. We have 2385. 2385. We have, ladies and gentlemen, 1.5. 1.5. We have egg. Egg, we have 2,000. 2,000. We have 2,400. 2,400. And then we have 2.0. 2.0. And then, ladies and gentlemen, they have given us risk-free rate of return. Risk-free rate of return is 8%. Risk-free rate of return is 8%. Risk-free rate of return is 8%. 8%. ERM is 15%. ERM is 15%. And then they are giving us a note here, a note that this is an all equity financed. It is an all equity financed company. company with a cost of capital, with a cost of capital of 18.5%, cost of capital of 18.5%, cost of capital of 18.5%. So required, number one, required, number one, required, number one, the company's beta factor. That's number one, the company's beta factor. The company's beta factor. 18.5, sorry. 18.5%. Thank you very much. 18.5%. So number one, they want us to give them the company's beta factor. That's number one. And then number two, they want us to give them to use CAPM. Use CAPM to advise on acceptable projects. By the way, in the other question, I forgot to tell you that overall, we only accept projects that are super efficient. In the other questions, any loss-making project should always be what here? Rejected. And as such, in the other question, we should have accepted A and what here? C. A and C. We should have accepted A and C. A and C. Ladies and gentlemen, please advise me. Once you finish writing this question, tell me done. Tell me done. Tell me done. Tell me done. Done. Thank you very much. Great. So, ladies and gentlemen, for 12 marks, how many marks do you think out of 12 will you get, Mr. Kigunda? For 12 marks, how many marks do you think will you be able to get in this question? For 12 marks, how many? Mengich, how many? Eight. Great. That's a student who is destined in this case here to do what here? 8 out of 12. That is pretty good. Pretty good. Eric says 12 over 12. Thank you very much, Eric. Meaning that Eric will be getting a distinction, a distinguishing mark from the rest. Meaning that Eric will end up getting an award. Kigunda the same. 10 is very good. Peter, 7 is good marks. Yes. Anything above 50% is good. Anything above 50% is good. But ladies and gentlemen, easier said than done. Easier said than done. I want to give you 5 minutes. We try that question, all of us. Just 5. Just 5. You see here, number one, they want us to give them the company's beta what here? Beta factor. For the number of years I've ever marked for CASNEP, whenever students are asked to provide this kind of an answer to this kind of a question, what they will do, they start looking for weights, and then they multiply the weights with what are these betas which are there. Yeah. Which will be extremely wrong, because, ladies and gentlemen, these projects, it's not all these projects that are going to accept. So you can't really put a beta factor of a project that at the end of the day, we may do what here, we may reject. Listen, they've given us something very important, that this organization is an all equity. Please underline this. It's an all equity financed organization whose cost of capital is 18.5%. Remember, this has been asked severally by examiners. Uses of CAPM. Uses of CAPM. One of the major uses of CAPM, ladies and gentlemen, which you guys must always be thinking about, is ascertainment of the cost of equity of a company. Ascertainment of the cost of equity of a company is one of those great uses we normally put forward this CAPM to help us to evaluate. So in short, ladies and gentlemen, you will comfortably use, in this case here, CAPM to ascertain the cost of equity of an organization. How will you do this? Remember, it is very easy. It is risk-free. Risk-free. it is risk-free, risk-free. Once you have risk-free there, into brackets, we have ERM minus risk-free multiplied by outside there, what here? Beta, multiplied by beta. Let me write this formula in a place where you guys can see that area you can't see very well. So you're saying that our cost of equity using CAPM will be equal to risk-free into ERM minus risk-free multiplied by beta of any security like that. So, ladies and gentlemen, the cost of equity, they have given us the cost of equity. This is an all equity financed, an all equity financed firm. It's an all equity financed firm. It's an all equity financed company whose cost of capital is 18.5%. So cost of capital has been given here, 18.5% equals risk-free. We know. If you want, you can put the percentages or you leave them. I like leaving them out. So we have 8% plus ERM. Expected return of the market, we have it. 15% minus 8% multiplied by beta of the company that we do not know. Now that we know the cost of equity of the overall company, the whole company, then we can use this formula here to get beta of the entire what year of the entire company. So your work will be to make beta equity the subject of the formula. Your work will be to make beta equity the subject of the formula. Your work will be to make beta equity the subject of what year? The formula. So please try your best. If you take this to the other side, it will be 10.5. How have I gotten 10.5? That is 18.5 minus what here? Minus 8. Because I flew this one to the other side, became negative. Equals 15% minus 8. That gives us 7. Beta of the company. Therefore, beta of the company is 10.5% all over 7%, which somebody tells me will give us 1.5. Eric, thank you very much for your courage, but are we together? Eric, I never saw your answer for this. Okay, but we are together. That is the most important thing. Oh, thank you very much. Thank you very much. So can I wrap this? So part 1, complete. I'm only asking for your permission to wrap this because I'm so sure you must have finished. Thank you very much. Ladies and gentlemen, we go to the second part. The second part is very easy. They want us to use CAPM to advise on acceptable projects. Of course, that will be on the basis of what here? The Jensen's alpha value. The Jensen's alpha value. So then if it's Jensen's alpha value, ladies and gentlemen, if it is Jensen's alpha value, then I need, ladies and gentlemen, to come here and first of all, get the CAPM returns of each security. Go there and give us the CAPM returns of each security. Please go there and give us the CAPM returns of each security without really struggling. CAPM returns of each security without struggling. What do we have there? CAPM returns of each security without struggling. What we have there. Fortunately, we know the formula. There is nobody who is really forcing us. We know the formula. We know that our CAPM returns should be equal to risk-free plus ERM minus risk-free multiplied by beta of the security. So if it is security A, the risk-free will remain the same. Risk-free, you told me, is 8. So I'll talk of 8 plus ERM. And the ERM, you guys gave me figures of 15 minus the risk-free. Risk-free, of course, will remain the same. Risk-free is 8. So we have 8. And I know I'm subtracting. And then outside here, ladies and gentlemen, I'll come and put what here outside here? The beta factors. Fortunately, they have given us the beta factors. So beta factors here are 0.3, 0.5, 1, 1.5, 2 like that. Thank you. So could you kindly give me these figures very fast, following your body mass concepts? Please give me these figures, following your body mass concepts. Please give me the answers kindly. So Lisa tells me that A is supposed to be 10.1. 10.1, thank you. And then we have boy, 11.5. I can see somebody giving me cow. Cow has disappeared. They became faster than me. Cow is at 15. Cow is 15. How about dog? Dog is 22. Somebody has given me egg as 22. How about my dog? My dog is 18.5. 18.5. Thank you, Mutie. Of course, I've been able to understand what you wanted to write. Thank you very much. Thank you very much. 18.5. Now, ladies and gentlemen, remember whatever you have gotten there are called who? The CAPM returns. Don't start advising us using CAPM. Ladies and gentlemen, if you get anybody, including those days, will become teachers. When you get students making decisions using CAPM, please tell them that they have committed, ID10T error. Tell them like this, that you guys, how do you make decisions using what here? Using CAPM. When you get them making decisions using CAPM, tell them that they have made what we call ID10T error. ID10T error. ID10T error. And then it will come later on. I'll be able to explain to you what ID10T error means. For now, I know, you don't know. For now, I know, you don't know. 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 Great. 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 So, the gentlemen, we only make decisions on acceptability of projects using what here? Jensen's alpha value. Jensen's alpha value. And this alpha of our security will always be given by ERS minus CAPM minus the CAPM returns. Minus the CAPM returns. Minus the CAPM returns. But now this examiner was a great examiner. I like such examiners because this examiner never gave us expected returns. He never gave us expected returns. Never gave us what we expect. What he did, he gave us expected, what do you expect as a money? Expected cash flows at the end of the year. But this is supposed to be expected cash flows at the end of the year. And of course, this is the cash outflow at the beginning. Now, ladies and gentlemen, if, for example, today you get, or rather you buy a loaf of bread for 10 bob. You buy a loaf of bread for 10 bob. And then tomorrow you sell this bread, a loaf of bread, for 15. For 15. So could you kindly give me the profit percentage? What is your profit percentage? What is your profit percentage in this case? What is your profit percentage in this case? You bought the bread for 10. You bought the bread for 10. You bought the bread for 10, but you've sold it for what year? 15. So in this case here, the profit alone is 5. So I'm so sure that you guys are great. You know that the easiest way of getting this is you take the cash flow at the end of the year, which is 15, divided by cash flow at the beginning of the year, which is 10, you subtract 1. You subtract 1. If you went to a very good high school, whenever you want to get percentage changes, that's what you do. You take end of year or end of month, you divide by beginning, and then you subtract 1. And then now you can multiply with 100. You can multiply with 100. You can multiply with 100. So are we able to get that 50% using this approach? Are we able to get that 50% using that approach? Yeah. So now here we are. So come here, ladies and gentlemen, and give us, come here and give us, come here and give us our expected return in form of percentage. So in form of percentage, I'll take the end of year divided by what? The beginning, minus 1. Whatever I get times 100. Whatever we get times what. Fortunately, all of us are the same. Those are just jokes. Those are just jokes in class. All of us are the same. All of us are the same. Doesn't matter what you got in high school, so long as you are a great hustler, you are hustling in your craft, you'll always succeed. So expected returns of A is 9.5. Is 9.5%. 9.5%. 9.5%. How about boy? Please give me boy. 1130 divided by this minus 1. Itakuja ngapi? No, Karo, ukishapata answer, because of compatibility with the other one, which is in the form of percentages, please multiply with 100. Yes, I'll do that, Patricia. Yes. So 9.5%. How about boy? We move with speed. Boy is 13%. Boy is 13%. Cow, somebody 18.67. Cow is 18.67%. And then we have dog. Dog. What do we have there for dog? Carol tells me 13% for boy. I've been able to confirm that is okay now. When I get many of my students giving me the same answers. So cow is 20. Beth tells me cow is supposed to be 28. Cow is supposed to be 28. There is a discrepancy here for cow. For cow, there's a discrepancy. Can a third person come and tell us, Beth, look at your cow. Look at your cow, Beth. It's supposed to be 1780 divided by 1500. Divided by 1500 minus 1. Just check that. And then now dog. I can't see anybody who has given me a figure for dog. Dog is 19.25. 19.25%. And then egg, I'm able to see 2400 divided by 2000, 20%. Thank you very much. Ladies and gentlemen, when you have expected returns in the form of percentages, and you have here your CAPM, remember these are CAPM returns, don't forget. These are your CAPM returns. What do you think will be the next thing to be done? What do you think will be the next thing to be done? What do you think will be the next thing that we should do? What do you think should be the next thing? The alpha, yes, alpha. So please come and give us alpha for each of these securities. Give us alpha for each of those securities. Give us alpha for A, B, C, D, E. And of course, you know that for us to get alpha, we normally take expected returns minus CAPM returns. Minus CAPM returns. Thank you. Expected returns minus CAPM returns. So you're taking this minus 10.1. I like what Juliet is telling me, that A is minus 0.6. A is minus 0.6. A is minus 0.6. Today, very many students have issues with the internet. What could be the problem? Someone like Fancy, I really sympathize with you. You are in, out. And I advised you really to get Safaricom. You see now I was right. Safaricom. Okay, at times it misbehaves like, but once in a year. Once in a year. Once in a year. It is the better option. It's the better option. All the others, don't work with them. Don't work with them. So A, Juliet gives me negative 0.6, and she's telling me that this one is inefficient. This one is inefficient. B, she's telling me it's 1.5, which is super, but I'm not getting anyone who is really confirming these figures. B is 1.5, super efficient. Caro tells me, thank you very much, Caro, for coming in, because you have been able to prove what Juliet is also telling us. 3.674 C. Super efficient. Super efficient. Kirui gave me 1.5. I don't know that is for which security, Kirui. Kindly specify. Kindly specify. Olifi has also confirmed that C for sure is 3.67, which is very good. Bernard says, yes, 1.5. Thank you for confirming it. Yes. B, someone else has also been able to confirm that is Pamela. D is 0.75, positive, super efficient. Ukitaka kumringia kidogo namwandikia super efficient, undervalued. E, I'm being told that E is negative 2. -2%, which of course means what here? Inefficient. And therefore, the securities that we shall recommend are which securities? The securities that we shall recommend are super efficient securities, which are B, C, and dog. B, C, and the dog. Thank you very much. B, C, and the dog.